Every time a venture capital fund makes a new investment, operations teams face a choice: issue a capital call immediately for that specific deal, or batch multiple investments into a single quarterly drawdown. Neither approach is universally correct, but the decision shapes LP relationships, administrative workload, and fund performance metrics. What's the difference between the two approaches? Single deal capital calls request funds from LPs each time the fund commits to a new portfolio company. A $50 regular fund making 15 investments per year might issue 15 plus separate capital call notices annually. Aggregated quarterly calls batch multiple investments, management fees, and fund expenses into a single drawdown issued on a predictable schedule, typically quarterly or semi-annually. LPs receive fewer notices, can plan cash outflows more easily, and operations teams handle significantly less administrative volume. What drives fund operations teams toward aggregation? The administrative burden of single deal calls scales quickly. Each capital call requires calculating pro rata amounts across all LPs, preparing formal notices that comply with the limited partnership agreement, distributing via secure portal and email, tracking receipt of funds, reconciling bank statements, and following up on any shortfalls. For a fund with 30 LPs and 12 investments per year, that process repeats dozens of times annually. Consolidating into quarterly calls reduces this overhead substantially. From the LP perspective, aggregated calls allow better liquidity planning. Limited partners with commitments across multiple funds can forecast quarterly cash needs rather than responding to sporadic requests on 10-day notice windows. When does the single deal approach make sense? Certain fund structures and strategies favor deal-by-deal capital calls, smaller LP bases, under 15 investors, where administrative complexity remains manageable, concentrated portfolios with fewer investments where each deployment represents a material percentage of the fund, and time-sensitive deals requiring rapid capital deployment without a credit facility in place. Some early-stage funds with close LP relationships also prefer the transparency of deal-specific calls, giving investors visibility into exactly which portfolio company their capital supports. How do subscription credit facilities change the equation? Capital call lines of credit have become nearly standard for established fund managers. These facilities allow GPs to draw funds from a bank secured against LP commitments and deploy capital immediately, then repay the line through a consolidated capital call weeks or months later. With a credit facility in place, funds commonly reduce capital call frequency to once or twice per year. The trade-off involves interest expense and setup costs, considerations that smaller emerging managers often weigh against the operational simplification. What should operations teams consider when choosing? Smaller funds often optimize for cash-on-cash returns and administrative simplicity, favoring a regular quarterly cadence. Larger funds with institutional LPs typically use credit facilities and aggregate calls to reduce LP burden.